National income for A-level economics. The two-sector economy. Consider the economy to be made up of firms and households. This model shows the interaction between households and firms. Firms produce goods and services which make up the national output. The national output is all the goods and services produced in a country in a year. Households provide the factors of production, which include land, labour, capital and entrepreneurship, to firms in order for the firms to produce goods and services. The firms pay household income in turn for these factors of production, and this forms the national income. This income comes in the form of rent in return for land, wages in return for labour, interest in return for capital, and profit in return for entrepreneurship. Households use this money they receive for spending on the goods and services firms have produced, and the value of this spending is the national expenditure. As a result, national output equals national income, which equals national expenditure. Income or wealth. Wealth is a stock of assets, so is the total value of all the assets owned by individuals or firms in an economy. This includes all the things people own, such as actual money, for example, savings, and physical possessions such as houses and cars. Income, however, is a flow of money they receive, for example, money for working or interest on savings. One way to view wealth is as a stockpile of resources that aren't currently being used in the circular flow, but could be used later on. Though income and wealth are different, there is a correlation. Countries and individuals with high wealth will likely have high incomes, since a higher income will enable purchases of more expensive assets and will enable a greater accumulation of savings. Injections and withdrawals. The previous model suggests that the national output won't change and is an overly simplified model. An economy's circular flow of income is also affected by injections and withdrawals, or leakages. To represent this, the government, foreign markets and financial services, for example banks, can be added to the model. Injections consist of exports, investment and government spending. Withdrawals consist of imports, savings and taxation. When injections and withdrawals are equal, the economy is in equilibrium and so the national income remains the same. If injections into the circular flow are greater than the withdrawals, then the economy will be growing, and national output, national income and national expenditure will increase. Whereas if withdrawals from the circular flow are greater than injections, the economy will be shrinking, and national output, national income and national expenditure will decrease. The multiplier effect. The multiplier effect is the process where an injection into the circular flow of income creates a greater change in the size of national income than the initial injection. This is because the initial injection will represent an increase in spending, which for example will lead to an increase in an individual's income, which can be further spent on consumption, which is a component of AD. The extra consumption will create more jobs and increase output. Applying this to a numerical example, if the government spends £100 million for firms to create new jobs, this money will be spent to pay households for the factors of production, so as a new injection of £100 million into the circular flow. If some of this income leaks out of the circular flow as withdrawals, for example £20 million on savings, £20 million on taxation and £10 million on imports, the value of withdrawals totals £50 million, leaving £50 million from the original £100 million for further consumption on goods and services, which will increase national expenditure, thereby increasing output. This cycle continues where households and firms will spend some of the money while some are leakages out of the circular flow until nothing remains from the initial investment. Overall, after the original 100 million has cycled the circular flow a few times, with leakages per cycle, the total GDP, which is the total value of all the goods and services produced in a country in a year, will increase by more than the value of the initial injection. For example, 100 million plus 50 million plus 25 million, and this continues further. The formulae to calculate the size of the multiplier are 1 over the marginal propensity to save plus the marginal propensity to tax plus the marginal propensity to import, i.e. 1 over the marginal propensity to withdraw, or 1 over 1 minus the marginal propensity to consume, where 1 minus the marginal propensity to consume is equal to the marginal propensity to withdraw. Therefore, the size of the multiplier effect is dependent on the rate money leaks from the circular flow. The greater the withdrawals, the faster the leakage from the circular flow, and therefore the smaller the multiplier effect will be. This is because less money is being injected back into the economy to continue in the cycle, as consumption, for example.